right, guys. Thank you so much for coming today and being a part of the conversation. Thank you, Ashton, for taking your time with us. We are very grateful to have you here today and to pick your brain a little bit. But I guess I'm sure you've kind of spoken to everyone on their own a little bit, possibly, maybe. So I'll let you kind of, introduce yourself a bit and we'll start there.
Nice. Okay, yes, I do see a few familiar faces. But yes, I'm Ashton Shumway. I've been in the multifamily arena for the last 5 years or so. I'm based in Texas, so hoorah, Texas. Have I got any fellow Texans in here? And yes, everything I own is in Texas, so I'm a big fan of Texas. But yeah, so I presumably everyone's here from MFM, so I am the MFM market research coach. I even have this fancy little background that, describes that. So, yeah, a lot of what we'll talk about today presumably will be CoStar, because CoStar is about the best thing you can have when you're doing market research. So, yeah, I'm open to take any questions, but I'm happy to be here. I'm glad to be invited.
Well, we appreciate you taking your time. And I guess you kind of led into it. And the first question I really had was, how did you start in multifamily? And how did you discover? Sorry about that. It would play right now.
Oh, well, I'll answer the first question while we get ready for the second question. So I got started in multifamily actually by the first job I took out of college. I was an personal assistant to a multifamily broker. He was like the third biggest transactor of multifamily properties in the Provo-Orem Metro, which was in Utah where I was living at the time. And so yeah, I learned a lot from him and kind of been in the multifamily game ever since that. So yeah, his area of focus was more on a little bit smaller properties. So most of his buyers weren't syndicating their deals. They were just buying for their own personal portfolios. But he did do a couple of the bigger ones. So it was a good time. That's how I got started. Oh, if it isn't Corey Turner.
Oh, yeah. And how did you discover that market research was your strong suit? Were you working in, how closely were you working with that broker?
Well, it wasn't necessarily through him that I discovered it, but as you can see, I wear glasses, and so you would expect that I'm more of a kind of on the nerdier side, and you'd be right with that expectation. So, just the analysis of trying to decide where do the numbers need to be for this market to be a good place to invest, and just the number side of it I find very interesting. And it was kind of like a calling that you might receive. You wake up in the middle of the night and you say, market research, that's where I need to be. So, and it's really just, after studying it for a couple of years now, I feel like I've got, a good baseline understanding to identify solid markets. But that's kind of how I came to market research specifically.
Ashton, can you give us a little hint on what some of the better markets are? Like we're kind of like focused on Georgia, South Carolina, North Carolina. You have any comments about those?
Yeah. So in my book, when you're defining a better market, the definition of that would be something to the effect of a market that's got above average population and job growth and above average cap rates. So essentially, if you're in a market where there's good population and job growth, most of those markets have been very heavy hit by investors, so cap rates are relatively low. But there are a few markets out there where that is not the case, where cap rates are still a little bit higher, and therefore you can get higher cash flow on your properties, especially in year one, and just better returns in general. So in North Carolina, South Carolina, and Georgia, there are a lot of really good markets in terms of their population growth and their job growth. Most of the markets, that with few exceptions, in those states meet the criteria of, very aggressive and strong population growth and job growth. Not as many of them have very favorable cap rates. And when I say favorable, I'm kind of, well, for guidelines purposes, if you guys would like to know what I think is good numbers in those domains. For job growth, I like to see north of 2% per year right now, especially. For population growth, I like to see north of 1% per year. And then for cap rates, I like to see between 6 and 8% in cap rates. So within Georgia and North Carolina and South Carolina, the only ones I really see as being favorable, at least by those definitions, is Warner Robins is a good one. Savannah does pretty well. And then in can't remember off the top of my head in South Carolina, but that we could look into that too if you guys are
Well,
really.
what about like right outside Warner Roberts? You have Macon, which it wasn't too far away from there.
Yeah, so it's an interesting dichotomy that there's those two right next to each other, but they are kind of substantially different. Let me share my screen. I'll show you a thing or two here between the two of those. And let's see, at least the last time I looked in Macon, it was not as favorable. So let's take a look at this. So this is the CoStar platform if you guys have never seen it before. So if we look in Macon, we can see over the last 10 years, the job growth in Macon has been averaging 0.45%, 0.45%, while the US has been closer to 1.3%. Okay, so roughly it's been averaging about a third of the job gains that the US has been getting. Currently, it's just a hair over, so that's actually a good sign right there. I'd like to see that. But then the 5-year forecast, and this is just CoStar's best guess. Their best guess is that it will be roughly 0%, while the US will be right around 0.4%.
Okay.
So not too outstanding in terms of job growth. And if we look at and compare that to Warner Robins, you can see as soon as this loads that historically Warner Robins has been right around US average. Currently, it's just a little under, but the forecast is that it's going to be, faring better than the US. So now you can't put too much trust in these forecast numbers. Ultimately, they're just CoStar's best guess. But I still like to look for markets that are showing at least US average, if not better, when I'm looking at some of these markets.
So I guess I'm going to throw up a follow-up question there, just because you said, you mentioned CoStar and how you use it to kind of, make your choices. In addition to CoStar, is there any other research tools that you do use to, kind of do your research, find out more information, and like how they form your decision making?
Yeah. So one thing you'll notice as you look at a map of, let's say if we're looking at this map of all these blue dots are where CoStar will have prepared a market report. And there are a lot of smaller towns that CoStar just doesn't have anything on. So like if you wanted to try to invest in any of these in central Georgia here, I mean, these are all small markets, but you're just not going to get any information from CoStar on them really. Mm-hmm. So for situations where that's the case, I've been using lately Reventure. They've got this, if you go to beta.reventure.app, this is nice because they'll tell you information on the metro areas, which CoStar only tells you about MSAs or metropolitan statistical areas. But here they'll tell us about some of these micropolitan areas too. So if you were looking at one of these micropolitan areas, Reventure will tell you a little bit about them. Mm-hmm. They will tell you it's mostly demographic and economic data. It's not very much, well, not as far as I know, anything necessarily about specifically the multifamily markets in these areas. So like if you wanted to look at multifamily vacancy, you're not going to get a whole lot there. But there is more information on this beta.reventure.app than on micropolitan areas than I've seen on almost any other online website. So this has been a really cool tool. If you're looking into some of these really small markets that are less than 50,000 people, that's the cutoff. So if it's more than 50,000, CoStar will have some data on it. If it's less than 50,000, you can come here.
That's a great tool to know.
Yes.
Definitely knew
Do
about
you
this, didn't know about this.
Yeah.
Is
And
this
it is very pretty. So,
Yeah.
lots of pretty colors. I like that.
Is this a good competitor to say like an app like Bright Investor? Ashton, have you had any experience with that program?
No, to be honest, all I know is that Bright Investor has recently come out and people are liking it. I don't know anything about it beyond that. As I understand it, Bright Investor pulls most of their data from the census. And this is also all of the data. Most of the data here is being pulled from the census too. So I would assume that it's mostly the same information, but I can't speak to that with any certainty.
Gotcha.
But it's a good question, a very fair question.
now this this reventure can we contact you for information on this, or is this an affordable tool?
Oh, it's very affordable. It's free.
Okay.
So
Oh,
Extremely
free.
affordable.
Still in
My-
beta
okay.
mode, I see.
my motto is if
Okay.
it's free, get it at all costs. So
Yes, okay.
definitely a good
Thank
one.
you.
Awesome.
So,
Thank you for
there's-
sharing.
Yeah, just so you guys can see that this is where you're going to look at like different information. So if you want to look at demographic information, population growth, if you want to look at they've got some interesting categories: payroll, jobs, poverty, median age. And then they do have stuff that's more specific to real estate. Like you can see, I was just looking at this: rent for apartments versus rent for houses, housing units. So lots of cool stuff here.
It definitely looks like something we're going to have to take a look and play around with.
Yeah, definitely.
Yeah,
It's a good asset to have.
yeah, definitely.
So I guess my next question really, what are like subtle trends that you notice in say like certain like an emerging market, or even maybe like when you start noticing a market kind of like declining? Are there little things that you start to notice that would really kind of stand out to you as maybe like a red flag or an orange flag instead of like a red flag?
That's a really good question. So generally speaking, if you see that there's a decline in construction activity, that is a red flag that things are slowing down in that market. So the way you would look at that, let's look here at Warner Robins. If you're looking at CoStar's reports, it's a pretty straightforward way to look at it. If you go to the very first chart, which is their absorption, net deliveries, and vacancy. You don't really see it very clearly here in Warner Robins, given that it's a little bit of a smaller market. But if you were to see that there was construction activity, let's say in the last 5 years, so all these blue boxes, if they were really tall, that would tell you that there was a lot of construction activity going on. And then if you looked into the forecast, CoStar has very accurate data up for the next 2 years on deliveries. And if you looked out here and you saw like no deliveries, or even in this case where you're seeing there's a property going to be delivered this quarter, and then there's one second quarter of next year, but they don't have anything else out for almost the next 2 years, then that's a little bit of a red flag that there's slowing economic activity in that area. So what you'd expect to see is that deliveries would be staying kind of high if there was expected to be a lot more growth coming. In this case, given that it's a small market, maybe it's not the best example, but we do see that there is no deliveries planned after the second quarter of next year. And that could be because builders are noticing demand is stopping, and so they're no longer starting new projects out there. So that could be the case. And that's really like a kind of a warning red flag of a market in decline. Early indicators for a market in emergence, so kind of the opposite trend, would either be, very little construction starts and then forecasting a lot, or if you notice that there is a very big employer that has chosen to move into that market, that usually stimulates a market like nobody's business. So, and you would see something like that if you go.
That's going to be my next question.
So something like that with Warner Robins.
Yeah.
Tyler just bought Arden place.
Mm-hmm.
Wouldn't that be a bad sign?
So that's what
I
I'm
mean,
saying.
He got a good deal.
Yes.
He got a good deal on that. But to me, the way you're making it sound is it's not a good going forecast.
Yeah, and let's jump out of a small market here, because in places this small, there's not a consistent amount of construction to really base your decisions off of. So if we looked at something bigger, let's go to Atlanta. So in a market the size of Atlanta, there should be pretty steady construction. And so that you're not looking at kind of off the wall numbers. So here, over the last 10 years, looks like there was roughly around 2,000 units being delivered every quarter. And then there was some increase here in 2022 and 2023. And then it's kind of gone back to normal / maybe a little bit on the slower side. Not too much. It's not a very clear example. You're not going to see it in every market, but it's just something to keep an eye out for as you're looking at this. So I can't think of any really clear examples of this right off the top of my head.
No worries. I understand that market research is a very complex piece, so it's understandable. You were going to go into showing us, I think, how you can tell if there's big players coming in to stimulate employment.
Yeah. So, close out of that. So if you notice, one of the things that we look for is like leadership in the Department of Economic Development or the Chamber of Commerce area, because those two bodies, one of them is a government body, one of them is just more of a fraternity kind of a body. Those two organizations, their job is to try to bring growth and bring jobs into their market. And so if they're being very aggressive and they're really hustling and they're bringing a lot of jobs into their market, then that's a very good sign. Those, because they're kind of on the forefront. They're the leaders of the job growth, essentially. So if they are doing a really good job, there'll start to be some signs, and usually the bigger signs are going to be reported on sites like business facilities, which some of you guys have probably seen through the path. But there's two other competitors to business facilities that do a similar thing. Areadevelopment.com is one, and siteselection.com is the other. So I like to look for I kind of read these like an old person might check the news. Just check in on them occasionally, see what articles are being posted, and look for notices that big moves are happening. So like a really, really clear example of this, you guys may have seen this already, is what Micron announced in Syracuse. Have you guys heard of that? Yeah.
Yeah.
So looking for things like this. I mean, most of the time, these kind of this is kind of a very big example, and that's why I like to use it, because it really clearly shows like there's going to be huge impacts from Micron moving into Syracuse. But things like this is really your very first early indicators that you see of a market that's in the process of emerging. So even like if you were to go into CoStar, if you were to look at Syracuse's numbers, like in terms of their job growth and their population growth, those numbers that you would look at would still show Syracuse as being a very poor market because it shows population growth is flat, if not declining. Job growth is relatively flat. But as this project gets into full swing, there's going to be that's going to change, and you just wouldn't see that just by looking at CoStar's numbers. So making an investment in a market based off of this when there's no numbers supporting it is definitely a riskier play. So like you're going to have a harder time convincing investors to invest into a market that shows negative job growth or something like that. But having this story where you can tell them, hey, the numbers in Syracuse right now don't look very good, but there's a story behind why we're going here that's very compelling.
So to me, it really seems like you're using both to make like a very well thought out decision.
Yes.
You don't want to use like either or. It's more so kind of like you using them as a unison.
Yeah. Having the numbers and the story kind of support each other. I will, and I like to harp on this a little bit. I will say that in all these indicators that we're looking at, so like we've looked at construction starts, deliveries, we've looked at, these announcements of jobs. In all of these things, I would say it's important to keep in mind that ultimately the biggest and most important indicators, the elephant in the room of indicators, is the job growth and the population growth. So like people oftentimes ask me like, okay, well, what is like, what about like this very niche indicator of like daily asking rent per square foot or something like this, where you can find information on it. It's not very widely available, but they ask me, what's the effect of that statistic on the market, and can you tell if it's an emerging market based off of this one indicator? And my response to that kind of a situation where people are trying to get really into the weeds as far as that goes is, if you were to make a list of the most emerging markets over the last 10 years, and you were to gauge them by which indicators showed the most correlation with emerging markets, that list will always be the markets that showed the best job growth and the best population growth. I mean, those have been the best emerging markets to invest in. And so if you look at little indicators like other things that can be good to look at, can be helpful, they're not going to predict the success of a market as well as job growth and population growth. So that's my little soapbox. So now I'll get off my soapbox if you guys have more questions.
No. I guess those are really the only two indicators that are really consistently, historically over time, just keep on performing in a given year historically. Then, that makes a lot of sense.
Yeah. So it's not very sexy. People will be like, well, that's so basic, but it's like, well,
hey,
you can overcomplicate it if you want, but it doesn't have to be that complicated.
Yeah, no,
for
not
sure.
at all. And Eric kind of touched base, I guess, and kind of where I wanted to lead into, and it's like, how do you assess historical performances in a specific area? Obviously, that's going to be looking back at like the charts and the history, but I don't know if the question is, how do you read it? How do you assess? I'm not sure if I'm asking that correctly.
Yeah, it's a good question. So one thing that's, very easy to do on CoStar is they will give you like the last decade of job growth and how it's performed. And so you can just see, okay, well, it looks like over the last 10 years, Atlanta has been consistently outperforming the United States pretty much every quarter in its job growth, right? One really fun way that I like to look at like the historical trends in a market is if you go onto the BLS website. So BLS is Bureau of Labor Statistics. So they're the main government body that's tracking job growth and job statistics. If you go to their website and you go to data tools and regions, states, and areas at a glance, some of you guys have probably seen this already just from our online training. You can, we'll say we're going here to Georgia. We want to look at the job growth in Georgia. Let's say we want to look at, let's go to Atlanta again. So if you go here and if you want to look at the historical information here, they've got this really good back data chart. So as we're looking, we can look at specific industries here. So we could look at, if we want to see the back data on mining or construction or manufacturing, any of these industries, we can do that. If we just look at the total back data, we'll click on this little green chart. We'll go to, and this is being recorded, right? So you guys can, because this gets a little complex here. So
Yeah, no, it's being recorded.
there's a lot of steps. So you got to go to more formatting options here. And then we want to look at all of their history that they have on the job data that we're going to look at. We want to look at the 12-month percent change, which is, instead of looking at the absolute number of jobs, we want to look at the growth in the job market, right? So that's the 12-month percent change. And then we'll go ahead and retrieve that data, and it will take us back a page. And if we scroll down, voila, we have this most wonderful little job growth chart that you can see all the way back to 1991. And in some markets, it will take you all the way back to the 70s, depending on when they started keeping data. And so here we can say every month what the job growth was, or it's the year-over-year job growth, but every month what that was, and every time it's over 0, it's positive job growth. Every time it's under 0, it's negative. So it's really interesting to look at. You've got the .com boom here, or bust here, and then you've got wait, that's not quite right. I forget which one of these is the .com bust. But then you've got 2007 here, where Atlanta lost jobs, and then you've got
Pandemic.
yes, thank you.
Yeah. COVID.
I've tried to block it out of my memory, so I have a hard time remembering what it's called.
Oh, I think we all have tried to block it out of our memories.
Yes, what a horrible time, but
Testing times it was.
yeah. So you can see, like, during the periods of growth, when there wasn't a national recession, Atlanta was consistently bringing in jobs, and it was bringing in a ton of jobs, almost 5% during this time frame, and then just a hair less in this time frame, and roughly the same in this time frame. And so you can see that Atlanta, except for during times of national recession, has performed very well. There's consistently been strong job growth, and that's, I think, part of the reason why people are very comfortable investing in Atlanta, and why there's a lot of investors in Atlanta, is because except during national recessions, it's been a great, been lots of jobs, abundant jobs. So that's good to know. But you'll look at some of these other cities where, job growth may dip for no particular reason. And it's kind of more of a, what is that, sinusoidal wave or something, if you're talking trigonometry. But yeah, this is a fun tool to look at back data and look at historically. You could say, okay, well, let's see how this market has performed historically. And you can see that some markets will lose a lot more jobs during recessions than others. And it's like, it will just kind of inform your decision on how this market has performed during recessions and what you might be able to expect in future recessions. Again, like, this, Atlanta is one of the strongest markets, so we don't see any real signs of worry here, but they don't all look like this. So I would encourage you guys to look into a couple of markets, and if you want to see this back data trends. I don't really know how relevant stuff that happened 30 years ago in Atlanta is, but I do know that in terms of the leadership of, like, some of the Chamber of Commerce and the Department of Economic Development, a lot of those people will hold their positions for years, if not decades. And so if the people who are really hustling to bring those jobs have been in during this time frame, they'll probably be there for a couple more years. And so that's it's a little more relevant to look at the last decade more so than 30 years ago. But still fun to see. If you like numbers, it's fun to look at.
Yeah. So now, would you maybe use this particular site also to assess, like, the demand of multifamily in a target market that you're looking at?
Good question. But no, I would not. So the BLS really shines when you're looking for job numbers.
Okay.
So housing numbers, demand numbers like that, I would not dip into this resource for that. That, as far as I know, they don't have any information on that. to answer that question of like, what's the demand, I would use CoStar. And you can do a pretty good analysis of that, looking at the supply versus the demand by going into the very first chart on all these market reports. You can see the blue is roughly a figure of supply and the orange is roughly a figure of demand. And so you can see how they kind of play with each other and influence the vacancy by their interplay. That's a very good question, though. Very good question.
Thank you for that, because I would have tried to probably myself, me, someone who does not know anything about research, I probably would have tried to figure it out with like the other charts. I would be like, maybe this will answer my question. And to that, I guess, because say like someone like me who's like extremely new and not really knowledgeable in like market research, what would you say is like a common mistake that you see new investors make? Or like a big mistake, even by people who maybe have been in the game for a really long time?
Oh, that's a very good question. A very good one. So, at least for what my experience has been with new indicators coming out of the MFM program, a lot of new syndicators pick their markets based off of what they hear is doing really well. So like you can Google, what's the best market to invest in real estate? And most of the time, Atlanta, Charlotte, and Orlando show up on that list. And so people are like, all right, well, that's where my research stops. And I know already that those are the best markets. So why would I do much about anything else? And there's a big problem with that approach. And that's a big approach that I see a lot of people take. The really big problem that I see is that those markets, especially if they're kind of well known as being some of the best investment markets, they're going to be very heavily hit by institutional money. So especially the markets that are over 1 million population. So, REITs will want to buy in those markets. Life insurance companies will want to buy in those markets. Even some sovereign wealth funds. So like governments outside of the United States, if they want to make an investment into the United States, they'll buy in those best markets. And that puts a lot of pressure on those apartment markets that it's very hard for new syndicators to compete against, especially if you're sourcing deals. If you're raising capital for other people's deals, it's not as big of a problem. But if you're the one who's going out and trying to talk to brokers, and you're talking to a broker trying to get them to send you deals that they already have 50 or 60 other people who they know would really be interested in that deal, it's a lot harder to make significant headway in those markets. So that's probably the biggest mistake I see people make. Like, we encourage students to look in secondary or tertiary markets. And most of those markets are not the sexy markets that show up on like, what's the best market to invest in real estate. So that's a big problem. Probably the biggest problem I see. You'll have, especially as a deal sourcer, you'll have more success if you go into like secondary or tertiary markets that still have good numbers. So like, instead of going into Atlanta, you go, Warner Robins or Athens or Gainesville, or maybe you'd come up here to Chattanooga. You come into some of these smaller markets, and you'll have a lot easier time sourcing deals and getting deals that will pencil out. Because a lot of these markets, they're great markets. Don't get me wrong. They got great job growth and they got great population growth, but you're swimming with the biggest sharks in the ocean if you're going into some of those markets. So
Very oversaturated with big players.
Yeah, that's a good way to summarize it. So I'd say go into some of the smaller markets and get started in those markets, and then as you become a bigger and bigger player, then you can go into the bigger markets where the more sexy properties are.
So a follow-up question I have to that would be, what kind of advice would you give maybe like new investors to avoid these mistakes? And I guess you kind of led into that, going to like, like the tertiary markets.
Yeah.
What other advice besides that would be good for, say, someone that's new? And then I'll have someone else ask a question. I think someone was going to ask a question. So
yeah, so I would just say, if you if you feel impelled that you really must be in a market like Atlanta, raise capital for someone else's deal. It'll be easier to raise capital in markets where, you know, if you're raising capital from 10 people and all of them can go onto Google and see the same thing that says the same, you know, like they see that Atlanta is the best market to invest in real estate, that will be a little bit easier of a sell for you as a capital raiser. And so if you're just raising capital, if your team is only focused on raising capital for other people's deals, then sure, you can go to Atlanta. But you can also, if you're wanting to deal source the deals, there are other markets that have just as good of numbers. Like if you look at Auburn and Opelika, I can never pronounce that right. This market, it's smaller, but it's got really good numbers. So like, you know, check out this job growth is really insane in this area. Cap rates are still high, so you'll find deals that will pencil. It's a small market. There's only 8,000 units in the whole market. But when, you know, deals will pop up and they'll be good. There's good population growth. It hits all of the numbers. But it's just, since it's smaller, there's going to be less competition from really big dogs, and that will make it easier for new syndicators, and you can find great deals. So it'll be great.
Awesome. Thank you. Helen, I think you wanted to ask a question?
Yes. Thank you. Yeah, so you were talking about big sharks, and you were also talking about the Syracuse area. And for newbies, let's say, right, can you say there are a lot of institutional investors out there that's trying to get into that Syracuse market? Because I've done some research in that Syracuse market, and I saw like the multifamilies that are in there, they're more like duplexes, right? And the multifamily apartment complexes are kind of out in like other areas, you know, like it's still around Clay, you know, that town, but I think there's only like, I don't know, I want to say like 20, you know, and otherwise it's construction, right? So like in that Syracuse area, it's heavy on the construction. There's a lot of duplexes, and of course there's student housing, but I don't know, I think to kind of stay away from that area, like the immediate Syracuse, you know, town, let's say. So as newbies, is it worth like, you know, like trying to source a deal out there, or would we actually be competing, you know, with the big sharks? Like, is it worth our time as a newbie? If you're in New York.
So on the specific case of Syracuse, that's a very good question. The biggest problem with Syracuse is in New York. And so New York is a very tenant-friendly state.
Yes.
So as far as, we could take a look at how many properties there are, at least the ones that CoStar knows about in Syracuse. So let's answer that question, because I'm actually very curious now. So if you wanted to source deals, say you want to see 50 unit or above properties, in and around Syracuse, it looks like there are 247 multifamily properties that CoStar knows about that are over 50 units. So yes, not a ton.
So does CoStar take into account like the surrounding towns all across Syracuse, you know, because Syracuse is like a main town, right? But then there's like the Clay and Cicero and Oneonta or something like that. Is that all factored into one report?
Yes. So when you're talking anything, like if you're talking Syracuse and in the context of CoStar, you're really talking about the Syracuse metro area, or the Syracuse metropolitan statistical area, which does include all of the little towns, Cicero, Clay. And you can see, it's kind of faint if you can see my screen. You can see, like, if you look in Cicero, there's what, 10 properties. And but yes, this is including all the way out to and you can go a ways out here and still be technically part of the Syracuse MSA. So yeah. And you kind of asked what's the as far as institutional investors making a move in this area. I don't have I don't have
Because, you know,
insider knowledge to know how heavily some of these institutional groups are hitting this market. I know that it's a smaller market. I think there's, off the top of my head, I think there's less than 1 million people in the Syracuse metro.
mm,
Or maybe just right around 1 million. And so generally most institutional funds won't look into markets that are around 1 million or less. So I would my best guess is that this is mostly smaller regional corporations or even private investors that are doing most of the activity in this area.
okay. So it wouldn't be like a stupid move, right? Because that kind of was like the question before, like, what do you not like to see your students, you know, follow, you know? So would you consider this like a
Yeah.
stupid move, you know?
No, I wouldn't consider this. Well, like my big concern with that comment, and maybe that sounded a little brash now that you repeat it back to me. My biggest concern with that was that you're jumping into some of the most heavy hit markets, and I would not call Syracuse one of the most heavy hits markets. Not by a long shot. So one way you can quickly kind of gauge it is just looking at the market cap rate. And if the cap rate's in like a 4 or a 3 market cap rate, then you got a pretty good chance that that market's been very heavy hit. And those properties they got a lot of interested buyers, or else they wouldn't be able to sell them for that low of cap rates. So that's a very good question. And I mean, if you want to pick this as one of your markets, you'd want to get real familiar with some of the landlord and tenant laws in New York as part of your market research, just so you are aware of those, and you want to talk to a lot of people who invest in Syracuse to get as familiar as you can with some of those laws, because you don't want to take it for granted that the laws are going to favor you as a landlord. But yeah, if you can find a good deal out here that makes a lot of financial sense, then it's I think it could be a very interesting place.
Okay, thank you.
Awesome. Now I will kind of open up the floor to anyone else who would like to jump in and ask a question.
I guess just to sort of add on to the Syracuse conversation, Ashton, would you even consider like any different asset classes or asset types in an area like this? You say like Micron's getting into this market. You know, they just announced it this past year. I've seen a lot of interest in storage self-storage units up there. I have a couple clients upstate that say it's been very hard for them to even find any space to put self-storage. You know, any mixed use cases that you would possibly see even in like the secondary markets just outside of Syracuse?
Yeah, I mean, I don't have a whole lot of insight into that question for and above the fact that a rising tide lifts all ships. So investing into other assets could be, I mean, from all I would know, could be a very good investment. I personally don't follow those other assets very much. So like industrial or self-storage or hospitality or whatever. I just don't have as much knowledge on that, so I can't really answer that question very well. But a rising tide does lift all ships. And so if you think about like, so with Syracuse specifically, I think the job market in Syracuse is roughly 600,000. There's 600,000 jobs there currently. And the expectation is that over the next 15 years, just by Micron and the supporting industries, there'll be another 50,000 jobs added. So, you know, with that amount of growth in 15 years, land is going to be a lot more desired than normal. So yeah, self-storage, there'll be a lot more people that need a place to park their stuff. Yeah, I think there should be a lot of growth in all sectors of the commercial real estate in that market. Good question. Very good question.
Awesome. So does anybody else have a question before I kind of change it to a bit of a lighter note?
Thank you for getting into the weeds with us, Ashton. I really appreciate you.
Yeah, it's fun.
Yeah. So, yeah, Vanessa, please.
Hey guys, how's everybody doing?
All is well.
I had a question for you, Ashton. How do you assess crime and how do you kind of say, no, I really don't want to invest here because of the crime, how do you assess it?
That's a good question. Crime is a little bit of a trickier statistic to follow because there's not as standardized of a measurement in the United States. The FBI kind of keeps their standardized crime statistics. But there's even differences in reporting, and it's a much harder data point to track. The tools that I use to look at crime, let me open them up. I utilize city data a lot. You guys have probably seen this one. It's a pretty amazing market research tool. But if you go to city data, city-data.com, you can search up a city. So let's look up Syracuse since we're talking about Syracuse. And from this, if you scroll down, you get to their crime rates in Syracuse area. And this is just going to be Syracuse City, so not Syracuse Metro. So what you can do is you can look over the last couple of years. They've got all these different ways of tracking murders, rapes, robberies, all these, you've got your violent crimes, and then you've got your property crimes. And then you can look across the bottom row to see what their overall index is. And generally, if you see a market that's over 500 in this ranking, that's a pretty high crime market. And you might want to consider maybe not being involved in that market because there's just going to be a lot of crime, or in that city at least. So this chart is not always perfect. You got to watch out. Sometimes they won't report burglaries 1 year, and that will make the crime look like abnormally low. But this is not a bad place to track crime and try to compare crime market to market. So this is where I spend a lot of my time researching crime in an area. Does that help?
Yes, thank you.
Okay.
Awesome question, Vanessa, because crime does affect and should affect where you invest. Families want to live in a peaceful area, and especially if you want to get a lot of tenants in there, and make sure that your rental ratio is at a good standing. You're gonna want people to go and live there, so I'm sure that's very important. Anyone else?
I can make one other comment on that.
Of course. Thank you.
So yes, it's important. Crime is important to know about the market. It can also be kind of localized. So you may have one side of the highway where it's very high crime and wouldn't want to invest there, but the other side of the highway is fine. And you could get very high rents on the other side of the highway. So when I'm talking about this crime, this is talking about kind of like an overarching number. You do kind of want to stay away from cities over 500, but you can go into this with the context of, if you find a property that's in kind of a higher crime city, you'd want to talk to the property manager, and you could also talk property managers in that area and get their feel for where does this property sit in terms of the high crime area. Is it in a low crime part of town, which it really can be over the train tracks, is vast differences in crime. But property managers tend to have a very good feel for where the parts of town are that they would want to manage and where they wouldn't. And so oftentimes when I'm looking at a property, I'll reach out to 1 or 2 property managers that I know, just from building relationships, send them an email and say, hey, we're considering this property. What do you know about this area? Would you manage the property there? And I've had property managers that will say, hey, we won't invest, or we won't manage that property just because of the part of town that it's in. So it's if you want to buy it, best of luck, but we're not going to manage it for you. So that's one little nuance I'll make in terms of in the discussion of crime.
So I feel like the importance of having a good connection with your property management team should be emphasized there.
So helpful. So helpful.
Yeah. Luis, you had a question, and then I'll go to Wendy after.
Yes, thank you. So besides the initial metrics of job growth and population growth, does insurance and taxes significantly affect the market, or is it just the property?
Yes, taxes and insurance affect it very much. The best way to really know about that is really through the broker. I don't have a great tool for gauging those numbers. So I will say, like in Texas, all the Texas properties that I'm a part of, taxes and insurance are our biggest expense, like by a lot. And then like if you were to invest in like Idaho or Utah or Colorado or Arizona, taxes and insurance are just part of your expenses. They don't really stand out in terms of percentage of expense. So it's important to know those things. You're really going to have to talk to your insurance broker to get a better feel as you're looking at markets, how big of a concern that should be on your radar. And then, talk to county assessors to find out more about taxes. But mostly if you're within 50 miles of the coast, then you're in like what's considered a high danger spot for insurance, and you're going to end up really paying for it. So watch out if you're within 50 miles of the coast. And then Florida and most of Texas, especially by the coastal Texas, those are just nightmares trying to get insured right now if you're looking at older properties. So if you're like older than 1990s, those properties are just painfully hard to insure right now, and you end up paying a ton to get them insured. So much so that it kills most deals.
Okay, thank you.
Yeah, good question.
I'll give the floor to Wendy.
Hey, Ashton. Thanks again for such great information that you're providing. I want to get your advice as far as what you would give to someone who is in a market where a lot of people are interested, and just to be able to be boots here in Georgia. And what advice would you give us besides all the information that you already provided with the great websites for market and data research? What else would you recommend that we could do to be able to bring to our team?
Okay, so you're saying, like, given the fact that you live near a very hot market, what can you leverage from that situation to make yourself an attractive partner?
Yeah, so we do a lot of driving around, and even though we have been living in the market in the Atlanta metro suburb area for a long time, I feel like every town is a little bit different, and it's exactly what you were talking about. And we just want to be more proactive to be able to take advantage of the time, and knowing that we have something valuable that we are able to provide. But sometimes we just get so overwhelmed with, like, where do we start? Where do we go? Where do we make these contacts? So I just want to get your insight on that.
Yeah, that's a really good question. So I think your most valuable and leverageable asset, given that you're close, is just your ability to make personal connections in person with brokers and with owners. So I would encourage you to absolutely, if you haven't done this already, take brokers out to lunch. Go, say, hey, we're new investing here. We live here. Can we take you out to lunch and pick your brain? Or you can say, we're students, we're studying more about multifamily. Can we pick your brain? So using the ability that you're very close by to build strong personal connections is going to help you out over people who are only on the phone with these brokers.
Right. Okay.
And then with property owners, there's a couple places you can kind of look to meet people. The very first one is going to be like local RIAs, real estate investor associations. Those are generally more tailored towards single family flippers and all that, but there are often multifamily people there. So attending those kind of things, occasionally American Apartment Owners Association, AAOA, will hold meetups. And if they hold meetups in Atlanta, I would absolutely be at those.
Okay.
AAOA. And then, yeah, just trying to be as involved in person at some of these in-person meetups as you can. So like
Right.
there's occasionally, like, you can look up on meetup.com, like landlord conferences, how to be a better landlord. You'll meet more people who own properties, and then just be as friendly as you can and just say you're trying to buy property. You're buying properties out in Atlanta. Does anybody want to
Yeah.
hear an offer on their property? So something like that. But
Okay, good.
yeah,
I
and
think
then,
we're on the right track
Yeah.
because I think we've been trying to do everything that you just said, doing more in-person meetups, which is yeah, I think we've been working on that. But that's good that I'm getting your insight on it. So okay, you
yeah, and then I'll just wish you the best of luck because it can be tricky in those markets. So
yeah, and just reaching out to property management companies as well. We've been trying to do our best at that.
awesome.
But okay, so I just want to make sure we didn't miss any other steps that we could probably take advantage of that we weren't aware of.
Yeah, I think you got
Okay.
it. One other thing, if I can throw one more thing in, look for kind of deals under 50 units is going to be less heavily hit by institutional money. So instead of doing one really big deal, do 2 or 3 small deals. And you'll have a little bit more, you'll have
Okay.
a better time with getting your offers accepted on smaller properties. So,
Okay, perfect. Yeah. Thank you so much.
I could definitely attest that like the RIAs are a great value. Me and Eric try to attend one. Well, we attend once a month. We actually joined our local one here in New York. And funny enough, the lady who really kind of like, I guess she's the host and the presenter, the one who kind of brings everyone together. She did ask like, does anyone invest in multifamily? And like she said, like over 50 units, and there was a couple hands raised in there. So it was a good note to take and kind of just like, oh, this person invests in multifamily. Maybe I want to go talk to them, have a conversation. Kevin, you have a question.
Yes. I have a question about Ashton. How would you repay somebody that's doing boots on the ground for you? Would that be just a payout, or would it like come to some sort of agreement, or as far as part of the partnership, or how would you handle that?
yeah, good question. Usually you're going to want to make your boots on the ground one of the GP members. So you want to give them some GP ownership.
Okay.
The reason I say that is because a lot of lenders will require that someone on your team lives near the asset. So it's not a
very good
requirement. So yeah, so you usually will need to have at least one person who's close enough by.
Yeah.
Yeah. And so, yeah, you usually want to give them GP, and it's not, I mean, it may be less than 1% of the GP, depending on if that's the only thing they're doing is just being nearby. But yeah, good question. Usually you're going to give them some GP.
Oh, that was good answer that I was going to go along with that. Thank you.
Yeah.
Awesome. So just because I do want to kind of go on a more lighter note now and shift over, I wanted to ask you, how has multifamily changed your life?
Yeah. Well, I mean, the biggest change for me was the very first property I bought was a duplex. We house hacked a duplex, my wife and I. And that was the biggest, like, as far as like percentage change in our financial world, because we all of a sudden went from having to pay rent every month to having no housing expense. And so then we just saved all the money that we were previously paying towards rent. And then we just shoveled that all into our investment account. And that was really cool. So it's a good feeling. And we had great renters. And so it worked out really well for us, thankfully. sometimes, there's more risk involved with doing a duplex, just because if your renter stops paying, then you're in more of a poor spot. But everything worked out well for us. And so that was the biggest change. And then it's on top of that, it's just been really fun. Like, people who work in real estate have a lot more, generally speaking, they have a lot more optimistic attitude about life, and they're much more go get them kind of people. And that's really just fun and invigorating to spend your career around, to work around those kind of people. So that, I would say, is some of the bigger changes for me.
I love that. I like to hear that, because that's definitely, I feel, kind of the avenue that I want to take in my life. I want to spend my life around more people who are just as like-minded and as lighthearted. Because nobody wants to be around someone who's always like upset and miserable out there, maybe in like their office box and kind of like dreading to be there, but they still go every single day. At the end of the day, these are choices that we're making. So I guess I just want to say thank you to you first. Thank you for taking your time, for explaining everything to us, and really for making your first step, because if you didn't make that first step, you wouldn't be here now talking to us and telling us how we can make our first steps.
Yeah, absolutely. And thanks again for inviting me on. It's been great to talk to you guys today. Some great questions. So it was fun.
Good. I'm glad. We normally just spend an hour, so I'm going to be very respectful of everybody's time. I know people have to go and do whatever they need to do. But if anyone wants one last question, or just to say a comment, I'll let you guys do that, and then I'll let you guys go.
Yeah, thank you for taking
When's your
the time
birthday?
Thank you.
Thanks.
When's your
everyone.
birthday and where do we send the presents?
That's a good one.
That's a good question. Yes. My birthday is on the spring equinox.
Spring.
So that's a fun one. March 20th. So
Nice.
you can send my presents. I don't know. Just give it to your wife or your significant other. That will make me feel better.
Oh, that's so sweet. That's so like you, Ashton. Yeah.
All
I
right.
love you. You got a present for Ashton's birthday.
She's happy. She'll be happy about it. All right,
right.
guys. Again, thank you guys so much for joining us. Thank you, Ashton. I'll let everyone go and have a great night. That's all for today.
All right. We'll see y'all.
Thank
Bye,
you.
guys.
Bye, guys.
Thank you.
Bye. Thank you.